ever get that feeling. You see these flashy claims about automated trading
Oh,
systems.
yeah, the ones promising the moon.
Exactly. Returns that just seem, well, a bit too good to be true. You're definitely not alone there. We get it.
Hmm.
So for this deep dive, we're really zeroing in on something vital. The actual return on investment, the real ROI of these systems.
To get the hype.
Right. We want to understand what really works, what actually delivers.
That's the plan. Think of this as your guide.
Yeah.
Your personal guide to navigating the whole automated trading ROI landscape.
Okay.
Our goal here is really to give you the tools, the knowledge, to see past the fancy marketing.
To understand what's really driving profits or losses.
Exactly. And we're digging into the key insights from a piece by the experts at Faida Ventures Ltd. Called Evaluating the ROI of Automated Trading Systems, What Investors Need to Know.
Okay, great source. So let's kick things off with the basics. ROI, return on investment.
Right.
At its core, it seems simple. Yeah, profit or loss compared to what you put in, usually a percentage.
That's the basic definition.
But when we apply it to automated trading, what are the really crucial factors, the things that genuinely impact that final ROI number?
Well, the Faida Ventures piece, it breaks down several really vital things.
Okay.
First up, the strategy itself, obviously.
Hmm.
You know, how often it wins, the risk reward on each trade.
Yeah.
That's the foundation.
Makes sense.
Then there's something that can kind of quietly sabotage your returns. Broker conditions.
Like what?
We're talking spreads, commissions, even slippage. That's how smoothly your trades actually get executed.
Right, a slight delay or price difference.
Exactly. Then how you allocate your capital and the power of compounding gains. That plays a big role too.
And the time frame, I imagine.
Oh, absolutely. The time frame you measure over. Are you looking month to month, quarterly, annually? It tells different stories.
So it sounds like that first number you see, that headline return, it's just scratching the surface.
Totally. The article really hammers this point home,
Yeah.
just focusing on the big advertised number. Classic mistake.
Right.
A high gross profit figure. It's like just reading the headline, isn't it? You miss all the important details.
Yeah, the context.
And what's really insightful in this piece is the focus on something called drawdowns.
Drawdowns. Okay, for anyone listening who hasn't heard that term, can you break that down? What does it mean practically?
Sure. So imagine your trading account value hits a new high point.
Okay.
A drawdown is the percentage drop from that peak before it starts to recover, how far down it goes.
Gotcha. The dip.
The biggest dip, yeah. And the article gives a really good example. Say you have a system boasts a 10% monthly return. Sounds amazing, right?
Sounds fantastic.
But what if it also has a 40% drawdown?
Oof. Okay.
That means at some point, nearly half your investment was, potentially wiped out before it recovered.
That's a scary thought.
Now, compare that to, say, a system with a 5% monthly return. More modest, but only a 10% drawdown.
Much less scary.
Exactly. The first one might hit higher highs, but the risk of a massive loss is just so much greater. And, a lot of new investors, they just see the upside. They don't think about the psychological hit of a big drawdown.
That's a really good point. How would you feel seeing your account drop 40%?
Right. Understanding your own risk tolerance here is just as crucial as the numbers themselves.
So it's not just what you could make, but what you could stomach losing along the way. Okay. So beyond that initial ROI number, what else does the article say is important when you're comparing systems?
Yeah, the piece really stresses looking at the net ROI.
Net ROI, so after costs.
After everything. Fees, slippage, those broker spreads we talked about, everything out.
Okay.
Then, like we just discussed, the maximum drawdown, how big was that worst dip?
Crucial.
And third, something called the recovery factor. Basically, how quickly and efficiently does the system bounce back after a loss?
Okay. How good is it at climbing out of a hole?
Pretty much. And Faida Ventures, they mention their focus on capital preservation. That really underlines why these risk measures are so vital.
It's about protecting your base capital, not just chasing huge gains.
You got it.
Okay, so digging deeper. That leads us to risk-adjusted metrics. Sounds a bit technical, maybe.
It can sound that way, but the concept is pretty straightforward.
Okay.
It's just about getting a clearer view of how well a system generates returns relative to the risk it takes on. Are the returns efficient?
Right. Not just raw profit, but profit considering the bumps in the road.
Exactly. Connecting it back, these metrics help measure that efficiency. The article brings up three key ones.
All right.
First, the Sharpe ratio. Think of it like a grade for your returns, but it also factors in the volatility, how bumpy the ride was. Higher is generally better, more reward for the risk taken.
Okay, Sharpe ratio. Got it.
Then there's the Sortino ratio. similar idea, but it specifically focuses on the downside risk, the bad volatility.
So just focuses on the losses, not the upswings.
Essentially, yes. It penalizes for downside deviation, not upside.
Interesting. And the third?
The profit factor. This one's simpler. It's just the ratio of your total gross profits to your total gross losses.
Okay. How much you won versus how much you lost.
Yep, and generally a profit factor over, say, 1.5 is seen as pretty healthy.
Okay. 1.5 or higher. Good benchmark. These sound like much smarter ways to compare systems rather than just that headline ROI.
Definitely gives you a more nuanced view.
Now, the article also talks about time. It's tempting, isn't it? You see a few good weeks.
Oh, absolutely. You get excited.
But that might not be the whole story, right?
Not at all. Judging a system on just a few weeks, maybe even a month or two, it can be really misleading. Markets change,
Different conditions, different volatility levels.
Exactly. What works brilliantly in one market phase might totally fall apart in another. So the article rightly says you need to look longer term.
How long are we talking?
Ideally, at least 3 to 6 months. Minimum.
Mm.
That gives you a much better sense of consistency across different market cycles.
Like judging a sports team on a whole season, not just the first few games.
Perfect analogy. You wouldn't get a reliable picture otherwise.
And what about testing? We hear about back testing, forward testing.
Yeah.
How do they help figure out the real potential ROI?
Right. So backtesting, that's using historical data. You run the strategy on past market data to see how it would have done.
Okay, a simulation.
Yeah. It's a useful first check. Does the basic logic even hold up historically?
Yeah.
But, and this is a big but, past performance doesn't guarantee future results. Markets evolve.
Always the disclaimer.
Always. That's why forward testing is so critical.
Which
Running this system in real time now, either on a demo account, virtual money, or maybe with a small amount of real capital.
seeing how it actually handles today's market?
Exactly. How does it behave live? Faida Ventures mentions they combine deep back testing with live transparency verified accounts, real-time dashboards, trying to get that fuller picture.
That makes sense. Seeing it work or not work with real money, even a little, must give you much better feel for it. Its quirks, its actual performance.
Definitely builds more confidence, or tells you to walk away.
Now, one last big factor the article raises, something that can really eat into your returns. Fees.
Oh, yeah.
Costs. Even a profitable-looking system could end up being a letdown once you factor everything in, couldn't it?
Absolutely. This brings up a key question for you, the investor.
Right.
What are all the potential costs?
Right.
The article lists the main ones. You've got your standard broker commissions per trade,
Okay.
then swap fees. Those are like interest charges if you hold trades overnight. If you're holding for days or weeks, these can add up.
Didn't even think about those.
And then performance fees or profit sharing,
Hmm.
where the system provider takes a cut of your profit.
A percentage.
Usually, yeah. So the big takeaway is your ROI calculation that must be net.
Yeah.
After all those charges are taken out, that's your real return.
So a system might show, say, 15% gross return, but if the fees are high,
Your actual take-home profit could be way lower, maybe only 5% or even less. It happens.
and the article mentions Faida Ventures uses a profit-sharing model specifically.
It does, as a way to align their interest with the clients. The idea being they only make good money when you do.
So they're motivated to make the system work well for the user.
That's the principle, yes.
Yeah.
It ties their compensation directly to your success.
Okay, so pulling this all together, it really sounds like understanding the true ROI of an automated trading system is way more involved than just looking at one big number.
Oh, much more. It's a comprehensive
It
look.
requires really understanding the risk.
Yeah, definitely. The risk characteristics, the drawdowns, and the consistency over time through different markets.
Plus meticulously tracking all those costs.
Every single one. You absolutely have to look past the shiny surface numbers, dig into the net returns, understand the potential drops, use those risk-adjusted metrics we talked about. That's how you get a genuine read on performance.
So, for you listening, hopefully this deep dive gives you a sharper eye, a more discerning perspective when you see those claims about easy money from automated trading.
Good.
Because assessing ROI properly, considering all these angles, it's your shield against hype, isn't it?
It really is. And it's a vital tool for managing your risk and actually growing your investment effectively.
Which leads us to maybe a final thought for you to chew on.
Yeah, thinking about everything we've discussed, the drawdowns, the hidden fees, the importance of time frame. Which single factor do you think investors most often overlook or underestimate? And why could understanding that specific factor be your biggest advantage when you're making decisions about these systems?
That's a great question. Definitely some valuable food for thought there. If you are interested in digging deeper into the approach from the source material we discussed, you can find more info at youtube.com at Fate Adventures.
Wherever you look.
Absolutely, wherever you get your information, always, always do your own thorough homework. Make informed decisions. That's key. Thanks for diving deep with us today.